going. Yeah, there we go. All right, so one of the biggest things about trading is going to be our risk management, leveraging our accounts and understanding what we're doing with our capital and how we can manage it to benefit us. Everybody would love to do a double up, right? If you knew a way for you to take $100 and to just stick it in a system and you get $200 back, I'm pretty sure all of you would agree to put $100 in something, right? If I could guarantee you guys $100 back, a 2 times, like you get 2 times your reward back, you guys would probably do it, right? So I'm gonna assume you guys said yeah, just because you guys are being a little quiet.
Yeah.
You're good. You're good. So
Go
I'm
for
just
it.
trying to get you guys to interact a little bit, make sure you're there and awake, right? So we're gonna assume like yes, you guys would like the $200 reward back, right? So we can assume that if there's some type of risk and some type of reward, you guys would probably take it depending on the risk to reward. If and this is where this kind of takes um, trading out of the gambling aspect, and we're gonna go over this real quick so that we can get you know drilled down into your head that trading is not gambling and it's far from it. It's an educated guess, and we're taking what we read, confluence, and all of these things. We're taking all of these things and we're going to put it into a risk to reward, and we're going to manage our trade, and we're going to make money through that risk to reward. We're going to leverage ourselves. I guarantee you all of you would take a 50-50 risk, not any time of day. Your money has to be a perfect whatever, right? We can depend on the scenario, but if it's a 50-50, you're willing to take a risk, right? The moment that I put 70% of the odds into my favor and you get 30%, right? So let's say we have $100 risk. You're going to go up bet $100 against me, and I'm going to bet $100 against you. More than likely, you're going to say yes to that bet because it is a 50-50 odd. The moment that I tell you it's a 70-30, 80-20% odd, you would probably not want to risk that money with me, $100 for $100 to get your money doubled up. It's just natural. You wouldn't take an 80. If I told you, hey, give me $100, there's a 20% chance that you'll get $200. I guarantee you guys probably wouldn't take that risk, right? It's just not smart. Now, if you were to reverse it, and if I told you, hey, if you give me $100, you have an 80% chance of making $200, you guys would probably take that risk, right?
Oh yeah.
Okay, perfect. So it would probably depend on the amount of capital you have to be able to take that risk, though, as well, right? So, like, let's just say the risk is $100. If you have $2,000, you are able to risk, right? And you have $100 on this bet right now, and you have an 80% chance to make $200. Would you take that risk knowing you have another $2,000? So if let's just say if you lose
Yep.
this, you have another 19 attempts at making this 80-20 split. Would you guys take that attempt?
Yep.
Perfect. But if it was in
Yeah.
reverse, you would. If it was in reverse, you guys probably wouldn't want to take the risk to begin with. You'd keep the $2,000 in your pocket, right?
Right.
Because at an 80-20, when you're losing at an 80-20, you would call that gambling, right? Now you're gambling, right? So when you look at the market, understand that it's not gambling, right? And the reason why I say this is because of the 50-50. We can take the 50-50 odds off the table by using confluences, by using technical analysis, maybe some fundamental analysis, knowing that the news is going to play and certain aspects around that. But the fact of the matter is, it is gambling comes off the board, and the reason why I say that
May
is that's
27.
you
With
said
that play I did today.
you said what?
Oh shit, my bad.
Oh,
I
you're
thought I
good.
was
You're good.
muted. I was talking about
Oh,
Bashar Valia.
no, you're good. You're good. Let me get back to where I was. 50-50 on it would be gambling. So let's just say if I was to, I don't know, play blackjack with you guys, and I was to keep a card up my sleeve to always give me blackjack. Anytime I seen a face card, I could swap it out and always, always win all the time. You guys would probably, or win a majority of the time. You guys would probably call that cheating, right? If we're gambling and I could pull a card out and put the odds into my favor for any reason, 80-20 split, you guys probably wouldn't take the gamble. You guys probably wouldn't take the chance. So it's not gambling, right? Because there's no cheating in this. If I look at this market, I can use technical analysis, indicators, moving averages, candlestick patterns, chart patterns. I can fucking keep throwing odds into my favor with the more confluences that I know, with the strategy that I have, right? It's the same way when you start getting into the other casinos. If you guys look into it, they have strategies for baccarat, right? They have strategies for blackjack and how you play it and how you count the cards and all that. There's a strategy to it, which means we're not going to win 100% of the time. Can you win for 3 weeks straight every trade? Yes. There's batters that go 1,000 batting average for many games in the beginning of the season until they finally strike out, right? Like, but the point is we need to manage our risks. Now, it's really hard to do, even for me and a lot of people, even at the heart of it, right? Because you have that I want to get back into it mentality. You have that I want to make my money back because I just lost it, and I
especially when you know you can win.
Especially when you know you can win. Especially when you're like, man, it's going right back in the direction, because you're just seeing it play out in your head.
Yep.
You're not giving it time, and a lot of it's going to be with opening up your stop loss, right? Knowing your leverage, right? So as you guys begin to trade, as you guys begin to risk your money, start watching the number that makes you nervous. For me, for instance, when I start feeling a $300 loss, it doesn't matter where I'm at in the market. When I see myself down $300, I start feeling some type of way in my chest. I'm like, man, I'm gambling. I'm risking something I shouldn't be. It feels like my strategy's off, right? So now, with that 300 risk, we also have my reward, which is a $1,500 reward. After $1,500 of reward, I know for a fact now I'm being reckless with my profits. Take the profit, right? Just take the profits, get out, stop trading, right? And we're all going to continue to do it, right? Because we want better days, we want longer home runs, we want higher profit to rewards, and it's perfectly okay so long as you, one, stick with your strategy, you don't overtrade your strategy or force your strategy, you trade your strategy, and two, you manage your risk appropriately, listening to your stop loss and walking away when you lose that trade. Because if you're going to trade while you're in the profits and then you lose the next one, walk away, because you're going to try to revenge trade. You're going to need to instill habits in you. I do not always have the best habits. I never had a mentor, so I'm having to break bad habits where I can instill good habits into you guys, right? And that's going to be the best thing about you guys having me right now, is I'm going to tell you guys what to do with that. So now, we're going back to the risk management, right? You're going to feel weird in your chest after you lose a certain amount of money. Figure that number out, right? And it doesn't matter the contracts. I'm not talking about contracts because we can figure that out next. What is the number that you start feeling like, oof, man, I'm not going to be able to return from this loss? For me, it's like $300. We play on 50K accounts with $2,000 worth of risk. $300 is literally almost a seventh of your account. That's a big portion of your account, when most traders or any professional trader will tell you to risk 1, maybe 2% of your account at most per trade. We'll never see good numbers at that point, being where we're at. We would have to stack up money until we see better numbers. This is why we go to prop firms. Prop firms give us that leverage. For $50 we now get, or $200 we now get $2,000. So it really helps us to be able to give ourselves a risk management system that works, and we're able to leverage. Even if we lose an account, we're able to work our way up and not risk all of that money initially. It really helps, right? So risk management is going to be what saves us. It's going to be how we preserve our capital. It's going to be how we look at every trade. As you build your capital, you're going to be able to scale up, scale in. You're going to be able to risk more per trade, jump in with more contracts because you know you have more capital to risk. So for instance, you should never be running with a full NASDAQ, like with a full NASDAQ contract. You should be running about 1 to 3 micros, when you're on a $2,000 account just beginning, right? Anything at 5 and 10, now you're really starting to risk your capital. You're really starting to put your account at risk for, volatile movement. And that's where it's going to get hectic. That's where your heart's going to race. And and I guarantee you, any of you who have traded, the moment you enter the trade, the moment that thing goes down 4 seconds and you're like, $20, you're like, I didn't expect that big move. I didn't expect that right now. Like, oh my God, it was supposed to just go straight up. That's why I entered it. It was just supposed to go straight up, and it just doesn't work that way. And there's that the moment your heart starts beating because you have too much leverage on the table, you have too much capital at risk, you have that risk management. So you guys need to, as you trade, as you guys trade, feel that number, because I'm telling you right now, you're going to lose your trades, right? But monitor yourself. This is where a trading journal, and just so you guys know, I'm creating some trading journals with Sedulous Society on it and all that. But grab a journal. I don't journal. I don't care to journal. I want to wake up, make money, and go to bed. But journal. I can view my mistakes and go over them in my head. But a lot of people, need to journal. Write down how you felt when you risked $300. Notice how you felt when you risked $500. It took me 4 years to realize that I was playing NASDAQ way too aggressive. I noticed that when I would risk one NASDAQ and it would start just going crazy, and I noticed it because I would go for 10 points, and 10 points is like $200. So now I can only do 15 points of NASDAQ, and that's I'm already my moves, I started to notice my moves, that these moves that I were making were 30, 40, 50 point stop losses. So if I could just open my stop loss from a 15 point stop loss and open it up to a 30 to 50 point stop loss, I would be able to see my 150, 250 point gain, or profit take, So, and how could I do that and still make the money I want to risk and still make, the money I want to reward, right? So I started looking into micros. I started noticing that if I go down on my contracts, bring down my leverage, go from minis to micros, it'll allow me to open up my stop loss. So instead of having 15, I have 30. And I'm able to have 30 because instead of having one mini, I have 5 micros, right? So then I can break that down again and make it a little more, right? But I'm going to determine that per trade. When I look at my strategy, when I look at these plays play out, I am going to look at how much it looks like I should be risking for this trade and how much I can leverage with my account, because this trade right here looks like a possible 15 point stop loss. And since it's a possible 15 point stop loss, maybe we get swept. I'm going to give it a little buffer of 5 points. So I'm going to get into about 3 to 4 minis, 3 or 4 micros, and risk that, where I'm still under $300 by far, and I'm still having some wiggle room. So now my emotions are off the table, right? But in order for me to take this trade, it's also got to be a certain number I'm comfortable with. And that certain number you're comfortable with has to be realistic, right? This is what's going to tell you if it's an A+ trade, a B+ trade, a C+ trade. Yes, the strategy can be involved in that, but it's going to be the risk to reward. And a lot of people are going to tell you, any professional is going to tell you that you need to be looking for a 1 to 4, a 1 to 5 risk to reward ratio. So that means you should be able to trade 4 times and lose 4 times in a row, and as long as you win 1, you should still be profitable. Well, why do I want to put my mentality, and I'm giving you guys secret knowledge right now, why am I going to put my mentality at risk? If I lose 4 trades in a row, I'm going to be scared to take my 5th trade. And that's just, it's just how it is, right? So when you go risking $300 for $1,500 sometimes, that's a lot of points to cover. That's a lot to be right about, right? But the fact of the matter is we want 1,500. So we can practice on these little moves, these big gains, right? And what we can start to notice is that we can scale in and only have to be in the move for half the position if we double up our contracts. So while as we're watching this happen, we can scale in, not have to take the full take profit and go about halfway in. And that's what I like to do. I want to get in and get out. I don't want to have to sit there and watch my trade. So you guys will watch me scale in quick and then just get out real quick. You know what I'm saying? And not take the full move, because one, I can watch it and be like, oh wow, it played out amazing. That builds my confidence. And in fact, it builds my confidence to scale in twice as much as before. That's why you guys see me make such big money, such as like a 6K day, because I'm not afraid to scale in. But I trail my stop loss, right? I trail it. I always move it. Now, when I start to get off of my risk management, when I start to avoid my strategy, which you're going to do, it's going to be the devil in your head. It's going to be the hardest thing you ever fight. It's going to be the thing in your head saying, just go back in and make your money back. Go back in and just take one more quick scalp. Go back in and you can make it back. Walk away. If there's anything I can tell you to do, just walk away for 15 minutes, an hour. Let the chart change. Let the chart change, right? So let's jump into risk management. Trading isn't about hitting home runs every time. And this is from the book, guys, chapter 9. Trading isn't about hitting home runs every time. It's about staying in the game. Protect your capital first. Profits will follow. If you lose it, nothing else will matter to you. You guys, I promise you, I love to trade. I love to trade. And nothing makes me more upset than losing all of my money and not being able to trade just a little bit the next day. I want to trade a $5 trade if I can. And that's what the mentality you should take all the way through. If you want to trade again, my brother does it all the time. My brother's really good about it. He really goes over to a demo account. I don't even do that, right? He's very smart with that. He'll get a couple of trades in and then he switches to a demo account, right? And then he continues to keep trading. Like, there's multiple ways you can keep trading. The same way there's multiple ways you can stay in on a live account. Lower your leverage, lower your risk, be factual with yourself and understand it takes time. It's going to take time to hit it, right? So risk management is the backbone of consistent trading. Without it, you're not going to be consistent. You can have a perfect strategy, you can have perfect indicators, you can have a perfect setup, but without risk control, one bad trade will wipe you out. I had a $10,000 loss the other day, and it was through multiple bad trades and bad risk management and just not allowing my account to breathe. So as I start going into these bad trades and they get worse and worse and worse, I start tightening my stop loss, but I keep over leveraging and adding more leverage because I just need to make it back. And then next thing you know, you blow your account. Don't do it. If you find yourself in there, walk away, right? Have a friend, and I've had my wife where I'm going to start doing something as well to help me. Give someone your password so that when you brag to them that you just made $1,000, they're the ones to lock you out. Get mad at them because they saved you $1,000 and you have to wait till the next day. Who cares, right? And it's gonna instill a good habit. Like I think I've been doing good. I've went through multiple accounts now. I'm actually seeing a lot of profit and not having to lose accounts now. And we've all been there, right? I've been trading futures for 2 years. Everybody is at a different level. Everybody is going to make the same mistakes at some point. Everybody has been in your shoes. Do not be afraid to talk to people about what you're doing that's wrong in trading, because everyone's at a different level in this. Somebody might be at candlesticks where you weren't at candlesticks. You might be at risk management where someone else is at strategy. Someone might be on strategy but needs help with their entry and exit. Everybody has a different level to this, but I promise you, psychology, what's the first 4 steps you do going in on a trade, as in reading the graph? What's the first 4 steps you do going in? What do you mean, Cortez? Like, what do I do for, you're asking, like, do I have a checklist to get into it? Like a checklist? Okay, so our checklist is going to be very simple. And I guarantee you everybody can answer this because we went over it. It's our 9 EMA strategy. Guys, do you know when we're going to enter and exit the market? Does anybody want to answer me for me?
Signal and confirmation.
Signal and confirmation. And what is the signal and confirmation?
When the candle closes above or below the EMA, and then that's the signal. And then if it closes above or below the EMA again, that's the confirmation.
The confirmation, yeah.
Yep, stays above, right? Stays above.
Yeah.
Right. Now, that's just an entry and exit model, right? So, Mark, that's going to be our final checklist on that. Throughout everything else, we're also going to run through a risk management before we take a trade, which is going to tell us, okay, we're able to take this trade based on the entry and signal, right? And then 2, we're going to go over like technical analysis. So we're going to use confluence. Do we see a bull flag? Do we see an engulfing pattern? Do we see a 9 EMA entry and exit signal? And does it meet our risk to reward ratio, which is what we're going to go over today. Right now we're going over risk management. If you need me to go over like 4 steps of entering a trade, Mark, we can do that together. You know what I'm saying? We can do that on a one-to-one, so we can go over that because it's going to be a little different for you and what you know already. So think of risk management as your armor, your trading armor. It doesn't make you invisible, but it does keep you alive for your next opportunity, right? So imagine it as the way you're going to be able to, it's going to help you last in the fight, right? We need to last, and it's like boxing, you know, just like anything else. It's endurance that's going to win this race, right? I think his name is Randall Howell. Randall Howell says it really, really well. He says a lot of people go into this because we're entrepreneurs, we're hustlers, we have this go-getter mindset, right? And the problem that people don't understand is in this industry, it's not the hustle, it's not going out and getting it that's going to make us the money, it's the patience that's going to make us money. So be patient. It's not saying you can't attack the charts, you can't go running at it, but you're going to have patience with this, right? And it's going to add up. It's going to all add up, right? Position sizing is going to know how much you really risk, right? It determines how many contracts, shares, or lots you take per trade. Your goal is to limit your potential loss per trade to a small percentage of your account. As I said before, you're going to want to risk 1 to 2% of your trading capital, right? So imagine you take 1% of your trading capital, which is like on a $50,000 account, it would be $500. You are willing to risk $500 per trade. That is a 10-point stop loss. That's 10 points in the micro NASDAQ. That contract, that's 1 to 5 contracts scaled, so a max loss of $500, right? You never want to over leverage. Your stop losses are your non-negotiables. You guys understand that? Your stop loss is your non-negotiable. It is your safety net. That is going to be, it tells you. So, and it's your safety net. So you'll see me use a 9 EMA strategy, and you guys know what our exit signal is, right? Or our exit is, right? Our exit is a signal and confirmation, right? But you'll notice I still put a stop loss as a safety net. I know for a fact you guys have seen the market drop 100 points and then go right back up to where it never dropped but 20. It sweeps. It sweeps so hard sometimes, right? And we don't want to be a part of a sweep. We don't want to be a part of a aggressive move down. So we're always going to have a safety net, which is going to be your maximum stop loss on that trade, which is, again, we're going to be able to read that per trade. This is going to determine if it's an A+ setup, a B+ setup. Damn, that plane's loud, right? So you're going to place stops at key levels, just a little bit beyond a key level as well, like a support or resistance, a high or a low, not just a random point, not just, oh, I see this nice blue candle. No. Because that is a recipe for disaster. Respect your stop loss, period. Just respect it. I mean, the market will happily take your money if you give it the chance, right? Just don't let it do it, right? So the risk to reward, right? Know your edge. Ratio of potential profit to potential loss on a trade. You are going to do this when you're taking each trade. You can't just assume that every trade is going to be a $300 stop loss, $1,500 reward. It's just not going to happen, right? So you've got to have an idea risk. And I want you guys to remember, you don't need to do a 1 to 4 risk to reward to win. If I can guarantee you $50 if you risk 100, and I can guarantee you a 90% win rate to make $50 if you risk 100, I'm sure you'll take it because you know you're going to win 5, 6, 7 times before you lose one time, right? So if you know for a fact you can make your money, just take the shot, right? Take the shot. It's okay. Just make sure it is a risk to reward you're willing to take. Make sure it's in your strategy. Make sure you are confident in that trade and you're willing to take that trade without it affecting your character and letting it affect your emotions to continue, right? So an example of your risk to reward, you have a stop of 10 points, it's $500, and you have a target of 20 points, a potential profit of $1,000. That is a 2 to 1 risk to reward ratio. Again, ideally you want to look for a 3 to 1 risk to reward ratio, but again, would you rather win 90% of the time, right? Or would you rather win 20% of the time and just make, 1 to 5? There's a chance you could lose all your fucking money at 1 to 5, having a 50 to 70% win chance. But if you have a 90% win chance, I'm pretty sure you would rather take that. We're here to make money. We're not here to gamble, right? I'm okay with taking $100 and confidently making $50 on a 90% winning trade. If you're telling me if I give you $100, there's a 90% chance that you're going to give me 150 back. That's a $50 gain. $50 gain for $100 risk. I'm probably going to play that a few times in a row, 5, 6 times in a row, maybe even 4. Because even if I lose, I'm only losing $100 and I'll still be up whatever I won through all the way up until that loss, right? So it's okay if you can increase your winning percentage. If you're winning 90% of the time, that means you're able to risk a little bit more and you're able to mitigate your losses a lot more. You're able to take that high risk or high reward steps each time as well. And again, it's all discretional. You want to do it at your own pace. Emotions kill trades. Fear and greed are your worst enemies. Stick to your plan, predetermined stops, position, and sizing, right? Always have risk to reward. Journaling trades helps identify patterns and mistakes and success. Treat every trade like a calculated business decision and not a gamble. Scaling in and out will help you make more money faster, or it'll help create, a little bit more of a volatile position, right? You can do this as things confirm into your direction. If you are going for a 100-point run and you notice that it pulls back at 25, but it did everything you wanted to do, and it's still doing everything you wanted it to do, and it pulls back, and you see a nice bullish engulfing off of the MA, it's all playing out, add to your position. You will come up a little bit more, but you add to your position because that run up is going to allow you to make more money. And what you can do is also scale right back out. So it's kind of like you can add to your position, grab the money, and come back out. There's multiple ways to scale. Be open-minded when you're doing this, right? It's just like boxing. Have different combos. Look at the market. Read the market. Understand price action. Risk makes reward. If you do not risk, you will not have a reward, right? Here's some keynotes. Risk management is not optional. It's what keeps you in the game. Protecting your account is more important than chasing small wins, right? So if you go up $500 and it starts coming back down and you notice it's at $100 and you start panicking, oh my God, it's fixing to go. Just take your money. $50 is better than negative 200. Put it inside of you. Put it hardwired into you. $50, a break even, is not a losing trade. Breaking even is not a losing trade. Breaking even is not a losing trade. Please remember that, because it keeps you in to fight the next battle. Protecting your capital is literally what makes you a good trader. Consistency, discipline, and preparation are going to be your best friends, your best allies. They're going to be your ace in the bag, right? Discipline to keep your risk management, preparation to understand what the risk to reward is. Is it something that your emotions can take? And then being consistent with your trade and strategy. Stay consistent. Once you start seeing consistency, once you start seeing confidence behind your trade, your discipline, your preparation, all of it begins to just level up into another way, to where you're having more confidence behind yourself. You're putting your phone down, you're closing, you're not paying attention to your trades because you know it's going to hit, right? And then at that point, when you're able to call this stuff, and you're able to sit there and be like, you know what, without a doubt, I know I can make $200 a day trading. You've already made the skill. You know what you're doing. At that point, it's psychology. It's you versus yourself. And it's going to be the hardest fight you guys ever fight. It's going to be you versus yourself, right? All the technical analysis we're going to learn, all of that chart stuff, all of it will go out the window when you guys start understanding and learning this stuff like the back of your hand. When you're able to open your phone and see a key level, when you're able to just gaze at an internal liquidity or a fair value gap or an order block, when you're able to just throw your eyes at it like the back of your hand and read it and know that that's a Maribozu, that's momentum, that's a sweep of the market. Like when you're able to just understand the vast majority of everything by looking at it, it's going to be no longer technical analysis, because you're going to have so much cocky confidence in yourself, which is perfectly great, because that's what's going to make you a winner, right? It's going to be also their biggest demon, because you've got to tell yourself, no, you know what it is going to be to win, the same way you know how it is to lose. because the whole way winning, you need to remember those losses. Those losses are going to make you, right? Even the best traders with the best setups will fail without risk control. Your goal isn't to win every trade. It's to stay alive, manage your losses, and let your winners run. Protect your capital, respect the market, and the profits will follow. Okay? And that's going to be the chapter 9 of the book. Go back over it, understand it. Now we're going to go into some actual charting. Mute RJ for a little bit. Alright. We're going to go over some basic, just regular setups. I'm not going to take. So like right here is a perfect example. If we wanted to, I can look right at it. We're breaking over a 2-minute fair value. I would want to just go because I know I'm looking with the team.
Order filled.
I'm looking with the team. Now, I'm over this 9-day. We've signaled and confirmed on a 2-minute. I'm just going to take a small risk to reward. Even if it breaks, it's not too much. And I'm going to come down to this internal liquidity. Whoa. There we go. That's a $42 risk, right? And I would be chasing this internal last high. I can go somewhere around here. Now, that is a $68 reward. Okay, if I want to, I can squeeze this in a little tighter on the fair value gap because I know other little strategies. Cool. We're also still right below the, the signal and exit sign, so we're good, right? I'm comfortable with this trade. This is a $25 trade for a $68 risk to reward. I'm pretty confident with that, right? I'm pretty happy with that. If I lose $25 and make 68, that's a 1 to 3 risk to reward. That's beautiful, right? That's a beautiful trade. So as you guys start to do more technical analysis, let's just say this starts to run. Let's say this goes up here and we hit this high right here, right? And again, you guys will learn chart patterns and you guys will start to advance and adapt and start to grow as a trader. You guys come up here and then all of a sudden you see it pull back right back to where I'm at. And I'm like, oh my God, I'm breaking even. But then I see this nice bullish engulfing pattern that I see right here, bouncing off that 9-day. And I see it bounce right here, the same way I see it here. I can then add one more contract because I can assume we're going to bounce to this next level. That's what understanding your candlesticks is going to do. It's going to tell you I'm confident that this just reversed on this key level, right? So we can let that one, just play out to see how that plays. But let's say we go and we start seeing a trade like this, right? And we start getting in. Do we want to take a trade like this? This is an entry here. Do we want to take this risk? Well, based on our signal, this would be a great risk to reward. We have a signal and a confirmation right there. And our exit would be right there off of that low that we see. You know what I'm saying? So, but then it comes into, do we want to take this one? Because our exit would be somewhere down here. And our reward is going to be somewhere right here. Because remember, we always chase external, internal liquidity. We can look at things all day long. Oh, we're coming down. Coming down. Can we bounce? Right? So it might not be that big move that I thought it would be, but it could be a small little bounce. Right? So we have different things. Like for instance, we see that this is sweeping down. If we were to get in the trade here, that's a beautiful risk to reward because we're aiming for here and we're trying to touch either this high, which we do eventually hit, or this high, right? And realistically, we're going to go for this. We would more than likely go for that high, right? So this would be,
question. Am I supposed to be seeing something on the screen?
You should. Oh, okay. Hold on. Yeah. You're gonna want to go into my shared screen. You're gonna see a shared screen if you're on your phone. You're on your phone. There's gonna be another screen you can click on that's showing my actual screen.
Oh, okay.
Let me know when you're there, boss. Pretty comfortable trade.
Okay, I see it now.
Perfect, right? So now we enter right here. And again, we catch the signal, right? Let's just say we catch the signal. Signal and confirmation. Even if you want to do this one, it don't matter. We still catch a nice trade right here, right? This, again, we're in, like, let's say we get in around here. Okay, however you want to call it. Our stop loss would be 1, our 9-day EMA, enter and exit signal, guys, right? But we want that safety net, right? Remember, we want a safety net. What happens when it spikes? On the 1 hour time frame, we can see this happen. Really disgusting. Look at this right here. This is 1 hour. That is over 300 points in 1 hour. I want you to see how it took over 12 hours for that whole move to be taken out in 1 hour. Do you see how drastic a safety net stop loss is? If you did not have that, you would blow your entire count in the sweep of a second of a market. Safety nets are needed. Period. You might not think it, and I swear to God, I've blown $6,000 in like a minute. And all it takes is Jerome Powell talking. And it moves.
Yep, I did it.
You know what I'm saying? Like, it can sweep for any moment, right? It doesn't matter what it is. The point is you need a safety net per trade. Whether it be a daily loss set for on your account as a hardwire, whether it be a stop loss. And again, I enter the market and then I manually put it, right? So let's say I did enter this market on the 1 hour. It would be a great time to enter the market on the 1 hour. And since I have one contract, this is a $200 stop, right? Let's just say my confluence tells me to enter this trade. Then through this trade, I start going further and like, you know what? I like the way this looks, whatever. I can start bringing that further out. I can start looking at these markets, right? That looks like a really good trade. We see this higher low starting to happen, right? So we know if we break below this line, it's a stop loss. Well, I'm not willing to give this whole stop loss, and I also know that this was a sweep in the market. I also know that this line was respected, right? This line was incredibly respected. Every time it hit this area, right off of this spinning doji, very powerful leg down on the 1 hour, right, on the 15 minute, right? We see that this is respect. These wicks show what? Does anybody know what this wick shows? These bottom wicks show. Does anybody
Hey,
know?
Dan.
Yeah, go ahead.
Somebody has need to mute this background noise. I can't hear you.
You're gonna have to mute RJ. I don't know if I can mute him for everybody. Server mute. There we go. Is that better for everyone?
All clear.
Perfect.
Yeah, much better.
All right, cool. And I am recording this too. Sorry if you guys got to watch it again, but okay. So, did you guys get that though? What is right here? What's happening right here with all these bottom wicks? Does anybody know what is the action? What is this price action talking to us right now?
The market's indecisive right now in this area.
It's decisive, but what do we have? Wicking right here. These wicks right here tells us that buyers are pushing this up. Buyers are stepping in at this level.
Buyers are pushing it up. Right.
Buyers are pushing it up, right? The same way when we see wicks pushing down, we see these wicks pushing down. Let me find one. Right here, you see these wicks pushing down. We see sellers stepping in, trying to keep this down. So you see this nice wick right here. We see these sellers step in, it pushed down. Then you see the buyers step in, it pushed up. Then sellers came right back in, pushed down, didn't have enough volume or didn't have enough to push it down, right? They exhausted themselves and it pushed right back up. Again, we see a wick, which is the sellers pushed down, sellers stepped in, engulfing this, and we see it pull right back down to these lows, right? So wicks are going to show you pressure. Wick is going to show you pressure. What kind of pressure? It's going to show you if it's bottom wicks, it's going to show you buying pressure. It tells you buyers are stepping in at this level. They do not want that level to be broke. These wicks are telling us these levels don't want to go any lower. If it breaks these levels right here, we have a free fall that could happen, right? We are then going down to the next level. What would be our next level? Right here, right? How do we know? How do we know? Well, based on history, we can see it tapped here, tapped here, tapped here, right? It swept this area. It swept it. It took out the liquidity. What kind of liquidity was sitting here? Well, this is going to be a technical analysis that you guys haven't found yet, but there's a gap here and a fair value gap here. It swept all this liquidity. If you were with us on the 9-day EMA strategy, I had mentioned a gap. I mentioned imbalance of liquidity. This is an area of liquidity the market didn't need in order to make this move up. So when this market came down here, so many buyers stepped in at this point. So many buyers stepped in right here at this low that the very next day it shot up and created a gap so big that it skipped from this first candle to this third candle, which is where you see the purple box at, right? That's a fair value gap. Now you see this gap where nothing hit anything, that's called a gap up, right? Because we're going up and it's an entire gap. This is called a fair value gap. Whatever you want to call it, that's ICT. Whatever you want to call it, such as a liquidity imbalance, right? Imbalance liquidity, whatever. It is an area in the market that the market was so aggressive, it didn't need contracts. You guys understand that there's slippage inside of this, right? So sometimes there might be a spot where you put your marker at 10 and it slips you for 11.5. It's because there was nobody at 10 to sell you the contract. It's realistic. It's a realistic market here. Someone has to be willing to purchase your contract. We're selling contracts, right? At this point in the market, they didn't need no more contracts. It all got skipped, theoretically. It went all the way back up to notice this fair value gap right here and grabbed this imbalance of liquidity, which then pushed it into this imbalance of liquidity. Notice how when we got again to this area was skipped right here. Notice how we grab it again, right? Notice how we have another, where was it? I'm so sorry. Right here, we have another one. It's very small, but we have another one. It taps right into it. These imbalances of liquidity are still illiquidity. Liquidity is areas of demand, points of interest. Do you need them to be that precise? No. But they give you insight on the market. They help you with where it's going. They help you where it's leading to. Where can I set my stop loss? Where is the next liquidity grab? Right? All of these things matter within technical analysis, not to always add them to your strategy, not to confuse you and to add these things, but maybe to help you with a stop loss, maybe to help you with an entry zone. It doesn't matter what it's called. It matters what it does. What is it? And the realistic term is liquidity. No matter what you call it, no matter how you want to portray it as and what name you want to call it, it's all liquidity. The same way chart patterns of head and shoulders is different types of supply and demand and market structure shifts. Just like bullish engulfing patterns and, those are order blocks, and, breaker blocks are, an order blocks being invalidated, right? Like there's different things to it, right? This isn't an imbalance, right? But these areas are good stop losses. They're areas for us to know, right? We know that if we enter, we know that, hey, this is an area of liquidity. Okay, so with an area of liquidity, I'm in this area of a high and this area of a low, because we only have so much time during a day. And I don't know if you guys noticed this, but this right here is from 6 in the morning till 12 in the afternoon. This is New York session. This is New York session right here, right? So we can look at New York session running up and we can say, wow, look, it ate into this fair value gap and it respected it for a second. And we took a nice little scalp because this is on the 1 hour. Well, let's break it down in the 5 minutes real quick, right? Let's break it down into the 5 minutes. We see an accumulation happen inside this fair value gap. You've got me, if you can't see to the left that there was a fair value gap in the 1 hour, and all of a sudden 10 o'clock, 11 o'clock in the afternoon hits, and the chart starts going sideways, and you see this signal at the accumulation inside of a fair value gap, and you don't take this signal down to the last low, I mean, bro, that's accumulation. It accumulated here. That's liquidity. Why wouldn't you take it? It runs back to the liquidity. Look what it did. It ran back to liquidity. It ran right back up here, right to there, It took it a second. But the market is here to chase liquidity. This is after hours. This is Asia session. You wonder Asia session. You wonder why it's taking you so long and why it didn't move like that? It's a different time period, different volume, different volatility. You still can make it work if you hold it out, if you have a stop loss, if you manage your risk, right? If we see this signal, right? We know that we have nothing for us to put for a stop loss. So where's our stop loss? Our stop loss is this last high. If we entered on the signal here, it's this last high. Where's our exit? This last low. Do I need to take this whole move? No. Why? Because I'm okay with hitting this 200-day EMA. Because from 900 to 797 is 110 points. That's $2,000, guys. Did I need the full move? No. I just needed a part of it. I just needed these people to show me where the market was going. I needed an ideal risk to reward, right? If I entered on this strategy, the signal 9, and I entered when it signaled, right? My stop loss would be here. My stop loss becomes 80 to 28. 80 to 28 is 40, 50 points. 40, 50 points. You got to be able to risk 40 to 50 points for 110. Did I need 40 or 50 points? No, the market never needed it. The market never needed it. But I needed a safety net. I needed a safety net. Right? Because let's just say we see this happening. I don't know about y'all, but that looks like a bull flag to me. I can show you where this breaks upside. It happened right there. Sounds like a safety net's required, right? Here, let's find another one where a bull flag breaks out, right? See another one where a bull flag breaks out. Here you go. Comes down again, breaks right back up, right? That was a terrible example. Hold on, let me see. Right there, boom. Bull flag, breaks up, gap up. You can go more to the left. See it again. Bull flag, breaks up, right? But we can tell based on our signal and entry and all these other things if we're gonna need a stop, like how we're gonna set our stop loss. We're confident the market's going down. I just need the closest area of liquidity to be my stop loss, because if it goes in to grab my liquidity again, we could be shooting for upside, right? So risk to reward is great because of that, right? But what we wouldn't want to risk is something like this. Oh, well, it pulled back, it ran down and it pulled back, so it should continue downward, right? So let's put our risk here. Let's enter here, meaning our risk should be up here. Our risk should be up there, or at least at minimum somewhere right here. And our reward should be right here. Now, we're really risking a 1-to-1. We're in the middle of this development. And it literally takes us out. And the whole time we're going to panic. Why? Because we came down halfway to our position. And then it ran back up halfway lost. And then it came back and broke even. And we should have just got out. We should have just got out. Please, God, just break me even and I'll get out. And you never fucking did it. You never did it. Just give me some money. You got some money and didn't take it. Then you went down. And oh my God, if I just break even, I'll take it. And you never did. And it ran and blew your account. Because again, we see consolidation in a bull flag and it breaks up and up. Right? So we have to have a stop loss. Something that's safety. Something that we're okay losing. And if we can't lose that much on that trade, we shouldn't be taking the trade. It's just that simple. Do not FOMO. Fear of missing out. There's plenty of money to be made in the market. And this market will make you money. This market is running 23 hours a day. You can open it and you can find you a way to make money. Every time if you look at it. You can force a trade, find a strategy. You can find some way to enter this market. You can find some way to exit this market, right? But consistency on one trading strategy, consistency to one chart. When you're trading futures, I do gold just to give me a little difference at night. But stick to one chart. Don't go to silver and platinum and the NKD and the Dow Jones, and stick to one chart. If you don't know technical analysis and you're still trying to make yourself profitable, why are you looking at different charts? Because they all work a little different. You're going to confuse yourself. The way one wiggles isn't the way this one is going to wiggle. The way this one moves isn't going to be the way that one moves. There's a different volume in that market. There's a different open interest in that market. There's a different delta, different Greek. There's different everything to those markets when it comes to options, when it comes to anything else, right? So stick to something and get consistent. Practice, practice, practice. Every time you see that strategy, whether you take it on a demo account or you take it on a live account, understand that you always have, you guys learned the 9-day EMA. If you didn't learn the 9-day EMA, go back, watch the video. Look at the entry and exit signal. That is a simple entry and exit signal. That is one confluence. That is the simplest way for you to enter and exit the market with confidence. You need to add to that. And this is something you add to that. What is my safety net? Well, if I'm entering here, I realistically do not want to go lower than here. And I really don't want to go lower than there. Right? And if I go to here, I'm happy. That's $82 for 128. Is that stupid? Probably on a risk to reward for somebody that wants to be 100% 1 to 5. But I know 100%, I'm okay with making $80, guaranteed 90% win rate. Because I know it's going to go up to there. And then I might have a little reaction to that area. But if it breaks out, it could go all the way up to here. And that's a 1 to 3. That becomes a very good risk, right? So I know the probability. I know what I'm looking at. I know the different liquidities. I can force any trade to come out. I can sit here and wait for it to come back and then show another entry and exit signal. But set yourself a plan. How much do you feel uncomfortable with? How much do you want to make in a day? Write it down. Know that, one, we have AJ. AJ is able to help you with your taxes when this comes down to it. He's able to get you into a tax club that is 0%, right? So we have a strategy at being able to make it 100% profitable, right? I'm working on it. He has it. He's able to do it and help us. But in the beginning, it's almost 50% taxes, right? So if you make $1,500, you're only making $750. Keep that in the back of your head for tax season, right? But the point is to make money with it and understand your risk to reward, and just make sure you are making the money that you feel is good, because you might be.
Can't hear you.
You can hear me? No? Hello? Everyone good?
I can hear you.
Oh,
I can
okay.
hear you.
Okay, perfect.
Yeah.
All right, perfect. Yeah. So, it's all gonna change for everyone, right? And anyone. You know, you might be uncomfortable with $500, and you might want to make $2,000. You might be okay with a $300, day, to where you're making $150 extra a day, right? Just remember that you do pay 50% in taxes. So whenever you're withdrawing money, put 50% of that money to the side. Does that mean you're going to give it all to the government? No, but it's ideal to do that for short-term capital gains. It can be anywhere from 30 to 50% depending on where you live. So think about tax returns. If you've saved 50%, you go bring all your money to the tax agent, and it ends up being 30%, you have 20% saved in an account for you. Great job. Now you can put that towards whatever you want because it's your money, right? You were smart with your money. So, do you guys understand risk management? Is there any questions on how we can do it? Every strategy, the way it's going to be set up is going to be different for everybody. The biggest thing is understanding how you feel about your money loss, and that your nerves become your stop loss. Notice it at whatever money. Take a note. It's at 150 all the time. It's at 200 all the time. And then notice with what you're okay with making a day. Is it 1,000? Is it 200? When do you stop getting in the market for another $50, right? And note that, because when we can know a perfect stop loss and a perfect take profit, we can then make a perfect strategy for 40 points a day, 80 points a day, 20 points a day. And we can also perfect your contracts, right? And we can scale in. So these are going to be things you guys are going to have to start writing down and noticing if you want to take this class or this, group discussion to another level with a one-to-one and implementing it into your strategy, because it's all going to be adjusted based on the person. Start with your emotions. At what point do you guys stop getting in the market? At $500, $1,000 win? That's when you're like, you know what? I'm good. I'm happy. I'm done trading. When do you guys start getting emotionally freaking out when you guys are losing money? Is it $300? Is it $500? Right? And then we can implement those into taking A+ setups, where we literally have you take one trade a day for your $500 reward and your $150 risk. Right? We can set that up to be possible within minutes of the day once we know how you're going to feel, how you're going to react, what you're looking for in the market. There's many things you're going to want to look for in the market, and it's going to be the biggest thing is your risk to reward. Because if you risk and reward and you keep yourself, you know that there's another day tomorrow that you're going to be able to make the money you want to make. It's the same way if you blow a tire, or if you go spend too much money on fast food or junk food when you go to the circus or whatever, right? You have money for the week, you have money for your bills, you accidentally blew a little too much, but you can make it work, right? And then you're able to come back and you're still profitable, still able to pay your bills because you just went to work, picked up a couple more hours, you had to work a little bit harder, right? This is going to take an hour. If you guys can spend an hour working for anyone else, or working an hour for yourself, or whatever, you can spend an hour learning this, because this is a perfect side income for you guys to take 5, 10, 15 minutes out of your day and make your paycheck in that 5 to 15 minutes, and then go right back about your day. And you can determine that based off of your risk to reward and your strategy. And you can set yourself up for success before you even know it, because you can set yourself a bracket order for you to be targeted in, or an alarm, or set an alert for you to enter the market when it gets to the level you want to. And you can also set your stop loss and take profit prior to, so that it's all set up and all based on how you want to trade. If you're a scalper, this helps you with internal liquidity. It helps you understand how much you're willing to risk. If you're a scalper, you might want to risk $50 for $200 and just keep hitting those movements on the 15-second chart or the 1-minute chart. If you're a swing trader, you might need 2 to 3 days for a setup. So you need to enter at the lowest point of entry, right? And then you need to go with a low contract size so that you're able to set your stop loss as far away as possible, to where you feel comfortable holding for 3 days. Even if you go up $500, come back down to negative $250, and then go right up to your $3,000 take profit, right? Everybody has their own style. Again, we went over this last time. All sports athletes, everybody in sports, they all train, right? NFL, they all throw passes. Baseball, they all throw grounders. Boxing, they all throw jabs and hooks, right? They all do it. But notice how David Ortiz has a different batting style than Manny Ortiz. Notice how Randy Johnson pitches differently from Matsuzaka, right? Think about how Floyd Money Mayweather boxes different than Mike Tyson, right? There's a style to it. What's your style? What are you comfortable with? What do you like to risk? What do you like for a reward? And what strategy are you having? Because all of it is going to start with your risk to reward, your entry and your exit, right? Once you understand what you're able to risk, once you understand what you're wanting to make in the market and what you're willing to risk, you can start from there, working yourself backwards, because then you know how much a contract is. You know that you only need 20 points to make your day a beautiful day trading. And you know without a doubt 5 minutes of your day makes that 20 points on the NASDAQ, and you can see it. So you need to be able to read the 1 hour chart, and you just need to be right about 5 minutes in that 1 hour every day from 9 to 11, right? Set yourself a strategy, and we can work on it together. If you need help, let me know. But you guys should already have an exit and entry, signal and confirmation. You guys should have a 9-day EMA strategy at your hands for an entry and exit. That makes it very simple. And now you guys should have a safety net stop loss, and it's going to be how much do you lose before you panic. Note it down, right? And a way to save you from that is your internal liquidity, your most recent supply and demand zone. Look at your supply and demand zones. Where does the market keep hitting? Is that comfortable? And where is the market chasing? Is that comfortable? And when you look at those risk to reward, is it worth your time? Is it worth your emotion? Do you think it's going to be that way? Because if you're going to lose $300 and it's only going to be worth $300 and you don't like that, then don't take it. Wait for your next setup. Maybe wait for it to pull back a little lower to where it's only $100, right? Or maybe let's bring down your risk, right? Bring down to 5 contracts or 1 contract, right? And let's see how it goes from there, right? And it's all going to be consistency, discipline and consistency, and working on it. It's not just going to happen overnight. I can give you all the ingredients, you know what I'm saying? But if you guys aren't going to cook nothing, or if you're going to burn the cake, I mean, what are we going to eat? Can't eat burnt cake. I mean, you guys can eat burnt cake, but I think that's a class, man. I think that's it. If you guys have any questions, let me know now so we can get it recorded. How do you guys feel about the class? What are you guys taking in from the risk to reward?
Good points, Daniel.
Appreciate it. Does anybody take away anything from
Loved
this?
it.
Does anybody?
Love the class. It's given me some great insight, and each time I'm learning new things. And excellent class this evening.
Are you guys understanding where your guys' stop losses can be now?
Yeah.
Yes, and I can actually refer back to the video.
Exactly, yeah. And again, we're going to look at internal liquidities. If we know we're chasing this high up here, and I'm entering right here, well, I'm willing to risk $100 for 600, right? You know, so it's one of those things. How much do you want to risk? How much do you want to have for a reward? And understand your feelings, your emotions, what gets you in and what gets you out. The moment your emotions come into this, it's the moment you start messing with your head, right? The moment you're not going to be able to make that money. So, and again, not saying you're not going to have emotional times when you're up 10 grand and you need to know if you're going to hold or not. I mean, just take the money. It's like, you know. One-on-ones. If you guys need a one-on-one, figuring out your strategy or fine-tuning anything, please hit me up anytime. I love this stuff.
Thank you. I appreciate that, man.
Yeah, man. Definitely.
Yeah, we'll talk soon, my boy.
Okay. Sounds
Definitely,
good.
thank you.
Yes, sir. All right, guys.